Welcome back to Inside the 401k, the podcast where we unpack the complex rules of retirement plans and turn them into useful knowledge you can actually apply. Today's episode focuses on two critical topics that don't often get the spotlight they deserve: special money types, like after-tax contributions, and how breaks in service can impact your vesting and future 401k benefits. Let's start by decoding something a bit technical. Pre, 87 and post, 86 after-tax contributions. Back in the day, before January 1st, 1987, participants in a 401k plan could withdraw their after-tax contributions without also withdrawing the earnings those contributions had generated. That meant participants could pull out money tax-free and leave the taxable earnings in the plan for later. Not a bad deal. But that all changed in 1986 when federal law introduced new rules. After that point, any after-tax contributions made on or after January 1st, 1987, what we call post, 86 after-tax contributions, must be withdrawn along with a proportional share of the earnings. So what's the difference now? If you withdraw pre, 87 after-tax contributions, you don't have to touch the earnings. But with post, 86, you do. That makes the sequence in which money is withdrawn from your account more important than ever. Many plans follow a withdrawal hierarchy that looks something like this: pre, 87 after-tax contributions; post, 86 after-tax contributions and their earnings; pre, 87 earnings. Then, depending on your plan design, rollovers company, matching contributions, discretionary contributions, after that, before tax contributions available for hardship, and finally, the rest of the before tax money, which becomes available at age 59 and a half. Why does this matter? Because how and when your money comes out can affect your tax bill and available balance, especially if you're taking in-service withdrawals. Now let's talk about breaks in service, and how they impact your vesting. A break in service can happen for lots of reasons: an approved leave of absence, disability, maternity or paternity leave, furlough, reduced hours, or even full termination. And here's the key: vesting only applies to employer contributions. You always own 100% of your own contributions. But if you're not yet vested and you take a break, you could lose progress toward full ownership of those employer contributions, depending on the length of the break and your plan's rules. Let's break it down further. 5-year rule. If you're gone for 5 consecutive years, most plans will consider your previous vesting service forfeited. That means you might lose any unvested employer contributions that were sitting in your account before your break. But if you return within 5 years, you may be able to keep that prior vesting credit. It all depends on how the plan is written. Now, for those serving in the military, there are special protections. Under USERRA, or the Uniformed Services Employment and Reemployment Rights Act, time spent on military duty counts toward eligibility, vesting, and benefit accrual. That means you're treated as if you'd never left. Pretty solid support for those who serve. Let's also cover family and medical leave. Under the FMLA, if you take unpaid leave for a new child, your own health condition, or that of a family member, it doesn't count as a break in service. However, it also doesn't count as credited service unless your employer chooses to treat it that way. So, you don't gain a vesting year, but you also don't lose one. Now what about rehired employees? If you left your company and returned, can you count your previous service toward vesting? Often yes, if you return within 5 years. But again, the plan design determines the details. Some plans use the elapsed time method to measure service, while others count actual hours worked. Let's look at a few quick examples. If your plan uses hours worked and you hit 1,000 hours in a year, you get 1 year of vesting credit. If you only work 900 hours, no credit for that year. And if your plan uses elapsed time, it's all about your anniversary date. Hours don't matter. What if you take a final lump sum distribution, then come back a few years later? If you took all the money, including non-vested employer contributions, your employer may require you to repay the amount plus interest if you want your prior vesting credit and employer match reinstated. Otherwise, you may be starting from scratch. On the other hand, if you were fully vested before you left, that status stays with you. Once vested, always vested. Even after a 5-year break, those contributions are yours to keep. So let's recap. Know the difference between pre, 87 and post, 86 after-tax contributions. It affects what's taxable when you take money out. Understand how vesting works, especially when it comes to breaks in service. And if you're in the military or on family leave, special rules apply to protect your benefits. That's it for this episode of Inside the 401k. If this helped clarify some of the more nuanced corners of your retirement plan, be sure to follow, share, and join us again next time. We've got more episodes coming soon to help you navigate every twist and turn in the world of retirement benefits. Until next time, stay informed, stay invested,